None of VPM Partners, Bob Kendall, or any of its officers, directors, employees, other personnel, representatives, agents, or independent contractors is, in such capacities, a licensed financial advisor, a registered investment advisor, or a registered broker-dealer. None of VPM Partners or its personnel gives investment or financial advice or makes investment recommendations, nor are any of them in the business of effecting trades or directing client equity accounts or giving futures trading advice tailored to any particular client situation. Nothing contained in VPM Partners broadcasts, on its websites, or in its written materials constitutes a solicitation, recommendation, promotion, endorsement, or offer by others described above of any particular security, other investment product, transaction, or investment. Copyright 2014 VPM Partners. All rights reserved. Terms of use apply. Reproduction, adaptation, distribution, public display, exhibition for profit, or storage in any electronic storage medium. Sole third parties prohibited under penalty of law.
Hello, everyone. We are live. Quite the dramatic entrance we make, huh?
Yeah.
Anyway, today we are hoping to accomplish two main things, which is one is actually building off the screen that we were working on the last session, and then actually getting through some maintenance and some conversation about things to do, things not to do, and things we see done that are wrong, and things that maybe we'll do right and wrong. We see it all. More wrong than right, unfortunately.
Unfortunately.
And that's why we're doing the show.
Yep.
So anyway, notice Mitch still has a sweater on. 48 degrees in Minneapolis, 99 in Scottsdale today.
Yeah, yesterday I took my my two older kids out for soccer practice. You know, we do that just to run them, and for whatever reason, it's at like 7 o'clock at night. We had the largest blustery wind that we've had all season, and it was just brutal. And so
yeah. Anyway,
yeah, so I need this water.
Go west, young man. Anyway, so folks, what we're gonna, I'm hoping that we can get through all of these elements today and try to do a really good job. I think last session I mentioned, I think on the Market Thunder session, I watched the entire session last time, and it was actually not awkward for me to watch myself. It seemed to make sense and flowed really nicely, so hopefully we get away with that again. So we're going to go over to the PowerPoint, and we're going to go back and just a very quick review. It's sort of like in last episode you saw. We'll go ahead and talk about some of the things, but what we talked about last time is really is getting a sound process around this whole building of portfolios, getting products that, and we haven't mentioned this particular term a lot, maybe a little bit, but scaling and branding your practice, and this is a huge part of what you need to do to really show, I guess, the differentiation or to show the abilities that you have inside your practice to be able to do these things. We talked about the setting of variables and time frames. Mitch, you have any thoughts on that real quick?
Well, just we touched upon it on Tuesday, but I guess it's worth repeating is, you know, a lot of advisors that we come across when they're struggling with their stock screens, it's because they got in the way. And there's a lot of different ways that can happen. One of the more common things is an advisor will take 3 or 4 different screens that may have been fine in and of themselves, but the act of trying to merge them together and mix all these different strategies creates a lukewarm blah portfolio that there is no sort of structure in place. And that's just another element where people have gotten away because they didn't stick to a predefined goal for a particular stock screen or stock portfolio.
Right. So we were talking about time variables and time frames, though. So I didn't address that, so I will. But part of that is setting the key variables, and what we're talking about here is time frames for review, updating. I like putting them on the spot here, but I thought we were,
I wasn't done.
I thought we were going down the list. Instead, we're talking about human bias and other things. But the things that we want to really make sure is that you set realistic variables and review times and increments that you're using for trading. As you know, we always, for the most part, I'd say 98% of the time we suggest that you use the intermediate models. But the variables and time frames are, setting up your review process of your screen and how you select stocks. And I would like very much for you folks to do it exactly the same way every time. If you do that, what happens is then you get this predictability thing that quants always talk about. And they use this word somewhat. And what it means is that when you're walking windows of time forward and you do them the same way, you actually, when you go and review those windows, you can actually make critical statements about those windows. If you were constantly changing those variables, you can't. There's nothing to review because you're doing something different this time you did last time. And that if you can get into a pretty hard-coded environment, it's going to be a lot better when it comes time to review, when it comes time to question the things that you're doing. If you're always varying, you're just out there somewhere. I don't know where you are, but it's not a good place, I can tell you that. So one of the other things is removing human bias, and I think I'm going to have to go out of this. I'm going to go to the PowerPoint so we can get to, we'll just run through here real quick. There's probably a way to go to a screen, right?
Yeah, I believe you should just be able to push the arrow key a couple times and we'll be all set.
Yeah, so anyway, I didn't do a very good job. So some of the things that we want to continue to talk about, this is my favorite line, is don't confuse activity with accomplishment. So a lot of times, like Mitch was saying in his discussion that you're talking about and you're looking at different screens, you pick 3 stocks from this screen, 3 from that one. The problem is you don't pick them the same way and they're random and you create a lot of randomness. And the problem with randomness, there's nothing that is predictable about it because it is random. That's why it's called random.
Right.
So when you're trying to walk forward a process, you want to keep as much of that randomness out of the process that you can. So VPM, from a logic standpoint, and its buy-sell decisions and its allocation decisions are programmed into a hard-coded environment, which is called an expert system. It's the same thing that's used in robotics. And by doing that, it's always doing the same thing every time. It's not changing variables and doing things of that sort. So I'm trying to get to the right screen, actually. Here we go. I actually got there finally. And this is, I guess, what, and I'll probably let Mitch talk a little about this because I know he can go on this particular subject. I can too, but give a little different perspective. But clients want time-tested process, not your feelings. I talked about this forever. I mentioned Walter Schultze, I think, on the last show or some show. Walter always seemed to show up in my life. I haven't worked for Walter for about 40 years, but that's another story. But the bottom line is it's really finding a way is to have a different relationship with your clients. I think your clients, I really believe this, want to have a doctor-patient relationship. They don't want to have a nice guy. They don't want to have all that. They want you to be pleasant. But, when I go to my doctor, I actually don't even care what he's like as long as he makes me well if I'm having an issue. And, he could be a biggest whatever, and I'm okay with that as long as he knows what he's doing. I really don't want to be his friend. So anyway, and I think that's what we're talking about here is keeping the feelings out, being very professional in that. And I know there's folks out there that are always promoting client events and you're drinking wine and you're gay and happy and that's supposed to make your business better. It doesn't. Oh, it does. It might have some relationship with clients, but when it comes down to it, they're going to scrutinize you for what you did for them. And you might have had just a wonderful conversation at that last wine mixer, that wine tasting you did. But guess what? Just called up and fired you. And they didn't fire you because of the wine that you chose. So anyway,
yeah, clients want to be able to know that they could trust you, but they don't necessarily want to be your best friend.
Yeah.
There was some insurance company or investment company a little while back that was running all these commercials where they had the broker right alongside either the man or the woman of a relationship. And I never liked those commercials because I just thought, man, that is such an awkward portrayal of the investment advisor client relationship. Because you don't want your best friend, you don't want a family member necessarily being the one. I mean, maybe it happens to work out that you're managing some friends or family members' money, but you don't want your entire client base looking like that when it comes to that relationship. Because the worst thing that could happen is for you to get emotional about the money, just like clients tend to.
All right. Well, let's. We're going to move on here, and yeah, Mitch. Mitch put this together. I have no idea what the point is here, so I'm going to let him handle this one.
So this goes back to the hindsight bias. You see a chart like this, and what's the natural assumption is that it's going to continue going up forever because all indications from this type of chart looks like it's going to go forward. If you go to the next slide, though, Bob.
You can do that, right?
I'll let you drive right now,
right.
Just for the sake of simplicity.
All right.
What that is the Case-Shiller U.S. National Home Price Index. So, although at the top of that chart, it may appear like it's going to keep going on forever, anybody that's owned a house over the last few years, you know firsthand what this feels like. And so with all things, there's a time where something is going to end. And I don't know how many advisors talked to us back in 2011 about gold and how they wanted to add this to their portfolios as an indefinite component to it because it's always going to go up higher. And like all things, there was a correction, just like there was a correction in home prices. And when it comes to selecting stocks or any component into a portfolio, you need to make sure that you're not having too much hindsight bias where you're bringing an equity in, or a bond even for that matter, that's had a tremendous run up, and then you're looking backwards saying, look how great this would have done. The real question is, what was your process, or what would have been a good process all throughout this time to bring securities into your portfolio so that you would have captured some of this, but not because you know how the outcome was after the fact.
Yeah, so same thing with commodities, steel, all the big boom errors. You remember looking back and you go, oh, I want to have that in there. Well, those things are done. It's like when CNBC announces that the market is now in a correction, it's down 10%. What they meant to say, the correction has already happened. It hasn't begun. The 10% is the correction, and by the time they recognize it, it's over. So, from the standpoint of being able to, have a good perspective, like you said, these charts do look like they're going up forever, and they don't. So let's. I think we're pretty close to getting. See here. So I guess we'll beat this hindsight thing down just a couple minutes more, because by 1:30 I want to be done with the screening. I think we're just going to keep moving and moving.
That's fine.
Concentrated bets is actually worth talking about for a second, but most of the situation there that's happening with VPM is it's a little different process. You're used to diversification having the absolute. I guess that's been the way that you tried to diversify risk. In our case, we've got concentrated bets with a sell discipline that allows us to move and change the dynamics or the overall beta of the portfolio by adjusting cash positions and taking different positions in and out. And that will actually do a lot more for you when it comes down to it than any diversified situation. It was kind of funny on CNBC today. One of the producers came up with a great idea. There's 149 stocks or something. They're dividend stocks, and they were talking about. Then they featured 3 of them that were actually up today. It was probably the only 3, but nonetheless they're always trying to find that situation. They always play. If you want to know what not to do, you can watch CNBC. It's usually a pretty good shot. Sometimes they have some interesting guests, and they're I guess said to be controversial, and they're probably most of those guys are more right than not. Netflix trades we're going to skip. What I want to do is, I guess we'll just go straight to VPM 2.0, which I am not seeing the screen change here right now. It should be up on the screen. There we go. There's a little delay. So anyway, we'll go in. How do we want to start this, Mitch? You want to bring up the screens? We didn't bring that up. What do you want to do here?
Yeah, let's go ahead and bring up the screens. And while you're bringing up that
Wish
spreadsheet.
I knew where they were. That would be really handy.
Operating without a net, as I say.
There it is. Look at that. How about that? Huh?
There we go.
Pretty impressive.
So
I'm going to take us off, and I think I have a screen just so it'll be easier to see that screen there. And then let me just bring that up here. It's up there now. All right. Sorry about that sound glitch. Start over.
So as I was saying, this is a growth screen that we put together. We've nicknamed it Bob's Growth Picks. And what this is an earnings per share screen where we're looking over the last year, seeing the earnings per share being greater than the last 3 years' earnings per share. And then we're looking again to see, all right, of the last 3 years' earnings per share, making sure that that's higher than the last 5 years.
Since this is mine, I want to add something in here. This is my concept here. And the concept is if I have a company that's doing better in the last 3 than they did in the most current year, looking back over the last 3. But then when I look at the 3 to the 5, I can see a general trend of growth over the intermediate and longer term. I'm gonna believe that they're doing something right in that sequence to hopefully continue to get this stock to grow. Sorry, just wanted to say that. At least they couldn't see how silly we looked when we were scrambling to get the sound on. So that's good. Glad I didn't have the pictures up there. Okay.
So in addition to that, we put in a few other filters just for sake of ease and working with this. We removed any ADRs. And we also made sure that it has enough volume to actually work off of.
How come you took the ADRs out?
Because that's what we've done in the past at your direction. So.
Okay, let me tell you why. Okay, I always say if you're going to do any foreign stocks, you're usually better off to use a mutual fund or ETF, somebody that has a better handle. A lot of us don't understand how like countries like India or China, how they're reporting and how to actually look at those stocks to determine they're very good. There's not some great ideas in ADRs that be used. There are, and some of the companies that are ADRs are actually do the bulk of their business here in the U.S. So you can use them, but we eliminate them just because of that bias. Many years ago, probably back in 2005, I had an advisor he goes, well, I'm using ADRs, but I'm using only like mega caps, like multi-billion, like 20 plus billion. So he got a bank in India that was like $40 billion bank, right? So that's supposed to be safe. Well, it turns out that I don't know if it was the Central Bank of India or somebody in the Indian government decided that was when the markets are going crazy on the upside, pre-07 obviously, and they decided to stop foreign investment for a while, and that bank dropped by 35% in 3 days. So it went from a $40 billion stock to a $25 billion or $27 billion. It was pretty brutal, just like overnight. So once again, not that couldn't happen here. It's just that sometimes some of these things you can really get yourself in trouble playing with some of these foreign stocks that you may not fully understand. But if you have the resources, you feel like you have sources that give you that ability, then that's another story. You know, it's your business, but that's the reason why we left that out. I just wanted to see if Mitch knew. That's why I asked. So go ahead.
In addition to this, what we've also done, as you see on the screen right here, we've created two different sheets on this, and we'll see if I could drive on this. We'll see if its technology is cooperating. Doesn't look like it is right now. Bob, go ahead and click on the actual screen itself, the screen tab.
Okay.
So what we did with this stock screen, we actually went back in time, and we screened this at the different intervals. So in this case, we did an annual screen. We didn't do it on a monthly or quarterly basis. We wanted to give some opportunity for these stocks to actually stretch their legs. Did you click that stock screen tab at the bottom? The screen tab? There you go. All right, so you can see here, if you just want to scroll through that list up and down, there's been a couple years that we've screened through this where we had a fair amount of names. As you can see, there were times that there was 50 names that passed the list, and then there were other times, like in the end of 2009, where that list drastically shrunk down. For the sake of this, I guess, academic back test, what I did is I kept the limit to 24 stocks actually, and in the case of the end of 2009, where we had a shorter screen, I just kept over some of the holdovers from the prior year. So for this screen exercise, I tried to keep it pretty cut and dry. You know, I did a hard start and stop every single year. Now, if this was something that I would have been running over this time period, as we came along to the maintenance side of this, and this is something we'll get into later on, I wouldn't just necessarily hard start and stop the positions, because some of these positions may have already been long in the tooth. Others may still have a ways to go yet before they sell out of it. But just for this back test, that's what I did. Just want to make sure you're aware on it.
I brought us back live so they can see us now.
Okay, so I can't.
So
I can't make my nose then.
Yeah, no, exactly. Anyway, so one of the things that I think is important to understand, and when you're looking at doing these screens and doing this stuff, and actually by the time we did that, I lost actually train of thought. So, but the bottom line is, when you're filtering these, I know what it was. And we're going to talk about this in the maintenance section, but one of the things that you can't do in a back test like this, and that Mitch was talking about hard stopping and restarting and just taking stocks out on whatever, 12/31 or whenever the screen was done, what happens there is you're cutting off trades maybe that VPM would have been in at the time, and that stock would have continued to grow or add value to the portfolio. When you just chop them off, and we've seen this, advisors do this, where they rescreen and they just chop them all off right there. I would say you chop some of the best trades off right at the knees of the trade. Maybe it's only 40 or 50% through its cycle, and you leave a lot on the table by doing that. So we'll talk about that in the maintenance, but that's by doing that. One of the things we'll talk about this here is that you can't see when you're doing a back test, so you can come with a fairly good idea how this would do by using these stocks and going back through the screens. We have the ability to go back and do a historical screen and walk forward on an annual basis. We could do it on a quarterly basis, whatever, but the problem is you can't see at the moment anyway. The problem is you really can't see what the VPM stats were at the time of the rescreen. So when we start talking about how to maintain these strategies, and I mentioned this in a previous session of having a good quality walk forward process, then that's where you start to get into having to know some of these other stats. So go ahead.
All right, so in this case, as I said, we kept the list down to 24. Bob, do you want to make any comments as to why we typically work with 24 stocks?
No, I'm just kidding. No, the reason why is just it's an even number. 20. Usually, I build stocks for like a 250 plus account. Depending on the platform you're on, you can use some of these with if you have a flat fee, or where you get X amount of trades per year. You can probably do this with a smaller account, but I did 24 because it was an easy number. It was even. Typically, I've suggested over the years 24 to 30 stocks for that 250 to half a million, maybe up to 750. Above 750, you probably do need to have a few more stocks, but maybe that's a show for later on, that we can talk about why you would want to have a larger set of stocks. A lot of mutual funds, they only have anywhere, depending on the fund, anywhere from 80 to maybe 200 stocks in the entire fund. And the bulk of the fund, by the way, is what I call pie filler. You're putting big, thick stocks in that can take a lot of volume, so they can put a lot of money to work. And then the value's made on the outliers and the smaller bets is how they try to add a little alpha over what the market's going to do. And there's some pretty good processes out there in the mutual fund community to do that. Meanwhile, don't forget they're embedding $1.50, 2.5% fee, so they got to overcome that, number one, and then they've got to make money for everybody. So.
And then, so in this case, as I had said before, we didn't always have that nice round 24 stocks on this screen. So if you go ahead and click on the Picks tab, you'll see what I did is I sorted this by market capitalization within each of these years. And just for visual sake, I went ahead and highlighted the top 8, the bottom 8, and the middle 8. And if you scroll through that, you can see the various different stocks that have appeared on this list over time. And you'll see that sometimes there wasn't a lot of options to choose from because that's all that passed. There was other times that we had quite a bit of distance between the top, middle, and bottom lists. Again, you see in 2009 that it was the entire list that we had to work with, so we kept some of the holdovers from the prior year. But in other years, you can see that the lists got fatter and fatter to work with. And we grabbed essentially a random, a somewhat random selection of stocks when it comes to by grabbing the top 8, middle 8, and bottom 8 stocks. We kept the process consistent, but we did it by doing it every single time. The names that came on it was somewhat random, though. Would you agree, Bob?
Let me talk about that, because I think it's important for everyone to understand that screening in general is random. Think about it. There's 18, it's probably a solid 12,000 symbols that most screeners will have on there, 10,000 to 12,000. And the result of all that is that all we're doing is funneling how we're randomly picking things. And as we look at this list, you can, by just picking the bottom and tops of these, what it does is it is random, but the theory is that all these stocks were created equal. So how is it possibly that you and I are going to be smart enough to figure out which ones are better than the other ones? It's almost like people would have asked over time that, how do you know, like, wouldn't it be nice? They want to know, when is VPM close to selling? When is it,
right.
I don't know. It sells when it sells. Why does it matter if it's close? It's like a dog chasing a car. What would he do if he caught it, right? So you just, what you're doing is by doing the top 8 and the middle 8 and the bottom 8, all that does is gives you a consistent picking. I worked with an advisor not that many weeks ago, and we took the way he was screening and did it. Then we did it my random way, and the performance was better. And I'm convinced, and this is why this human element, this human bias comes in, is that we tend to pick things that we like, but what we like may not be the best thing to use in a portfolio, or maybe I like this characteristics in that one than the better one, and it all becomes random. We've seen some folks out in the field have some great screening techniques and all kinds of stuff, but then when it comes down to the final filtering, they just seem to pick all the wrong stocks somehow. And you do something, I have no idea how that could happen sometimes, but it has happened, hasn't it, Mitch?
It has. Some of these portfolios that we've seen over the years with too much human interaction, it looks like they intentionally tried to make a terrible portfolio, and they succeeded.
Yeah, and I try not to tell it, but it goes back to that lithograph with the two professors. They had the complicated deal calculation there, and they had a little squiggly line in the middle, said a miracle happened. And that's kind of what the technique that we've seen a lot of advisors use. They try to use the miracle part, and it never seems to come together just like they'd hope. So I don't care, by the way, if you sorted this list by any of the columns that come on the screen, whether you're using a 1/3, you want to put a bias to the 1/3 or the 3/5, or if you're using some other type of screen and you want EPS rankings, VPM rankings, don't care. Just do it the same way every time. Goes to what I was saying earlier. If you walk forward these things the same way every time, then you can scrutinize something about that process because you've done it the same way. Say, something is not right here. When you're making more random choices and filtering choices, you're not going to be able to go back and figure out why it was like it was. So this was, I've spent probably my whole life trying to keep the emotion out of trading, especially out of my own trading and what I do. So why not come up with a random selection process, but the randomness I'm talking about on the screening is that the reason why I call it's random is that we're picking out of 10,000 stocks. Somehow we're going to narrow it down to the absolute 24 that are the perfect ones. No, we're not. What we do is we bring it in, those 24 come in, VPM's going to pick out which ones are trending, and then out of, typically if you look at the trade profile, we probably should show that when we bring it up.
Yeah.
You can see, how much this thing's being invested, where it's being invested, and those type of things. And you just don't want to put too much of you in it. You want to make it very, very methodical, very quantified on every decision you make. You ever notice how relaxed Mitch looks to me? He's all leaned back there.
I'm actually sitting up straight.
Wow,
It's just the chair.
He looks like he's leaning back. Anyway, I'm always busting his chops on this. Okay, so where to next? Want to go to VPM 2.0?
Let's go ahead and pull up 2.0, and we'll actually see this. Now that we've talked enough about the screening process, we could actually pull this up.
Where did you put it?
All right, should be under subscriptions for you. There it is at the very bottom, Warriors Growth.
Okay.
So what we did with this, and we'll talk a little bit about portfolio construction as well. One of the dangers when people grab a stock screen is they'll just grab a list of, we'll just say 24 stocks. They'll just toss it to a portfolio and see, well, how is this done looking backwards in time? Perfect hindsight back tests. I think one of the most common ways I've seen this done is when advisors do those lovely Morningstar reports. They'll grab a nice MPT type portfolio and they'll allocate it just right so that when you look backwards over the last 10 years, it's handled the markets in a fashion that they find pleasing. The problem with that is that wasn't actually a portfolio that they had constructed 10 years ago. It just looks really pretty looking backwards in time. So in this case, because we actually went back and did annual screens on this, as we roll through these different years, go ahead and scroll down a little bit more, Bob, so we get the annual returns on that as well. When you see these returns year by year by year, it isn't because we took the current list of 24 and back tested just those 24. We did year by year using this methodology and turned them on and off using starts and stops. And so the basket of 2008 wasn't the basket in 2009 or 2010. There may have been some holdovers or some carryovers if they coincidentally appeared on both the screens. But the way that at least that I constructed this back test, that wasn't the case. So you can see in 2008, we significantly reduced the exposure on the downside with this fairly aggressive stock portfolio, or growth-oriented portfolio, I guess I should say.
Got whacked pretty good when Lehman went down.
It did. But then you see in 2009, it was up 45%, 2010 up 23%, and so on. You can see it from there. So it's done a great job of limiting, reducing the downside participation and still having that upside capture. And you see right now, like most of the securities in our database, it's only about 50% invested.
Yeah, I'm popping around here a little bit. I'm going to compare it to the S&P here real quick. That comes up. See if I can get that actually to show up on the screen. There we go. It's coming up.
There you go. So you can see in the first part, right before the crash really started getting really, really brutal, it participated, it outperformed the S&P 500. It did obviously participate to somewhat on the downside, not nearly as much as the market, but it still had some nice up years from that point forward. So I think this is it's done very well. Even last year, up 28%, right in line with the S&P 500. So it's deployed capital when needed, and it's taken protection when needed as well.
And one of the things I want to point out here is because this was built the way it was, There's actually a bug flying by my face. Sorry, that's pretty awkward.
Started losing
Live
love,
TV,
huh?
live TV. But one of the things that you can't do to determine exactly what it would be is when we talk about the walk forward process, which we're going to switch to fairly quick because I want to spend some time on that. We're already half past the hour, so but there are some things that probably would have been a little bit different with this particular portfolio if you had the full way to go and review and do some of the things that were going on. And probably if you were reading my commentary in 2008 in August, you probably would have had your head pretty far buried into the sand, hiding from everything, and had nothing on. But but from a pure screening standpoint, and this was an annual screen, these stocks came in at the beginning of '08, and the same stocks that are out there. So I don't know, didn't look through the picks, but anyway, enough about that. Is there some other elements you wanted to bring up, Mitch?
Well, you referenced the investment histogram, so why don't you go ahead and pull that up so that we can take a look at that.
So under trade profile, for those that have used the software for 5 years and don't know this exists, let me just get there here real quick. You go on a portfolio, bring this up. There is an investment histogram, which I'm bringing up right now. Move that over a little bit, and it's not showing everything. So let me, I think I need to reduce this just a little bit. This is going to be better there. Okay. So what this shows you on this particular portfolio, it shows how the capital has been used. And those of you that have looked at our new dashboard that we have for the premieres, you can actually see some more detail than you see this, plus you see the percentage as well. So anyway, you can see that the bar on the far right just pegged up there. It's about 300 and some odd days where this portfolio was 100% invested. So I didn't look to see how Mitch built this. Did you do a moderate?
Yeah, I used moderate.
Okay. Yeah, so anyway, this thing has definitely had a lot of days where it was pressing the envelope to make things happen. And it looks like the balance at the time was between 70 and 80, and then there was a fair amount of time in the mid-range there. And you're looking at probably 2010, this goes back to 8, so parts of 8 and 9, and then 2010 and 11 where there was some, and more in 11 where there was more protective and cash being brought up. But even then, you only accumulated 100 days, just short of 100 days of 100% in cash. And I can tell you, prior to 2008, I had never seen a stock portfolio that had 24, 30, 40 stocks go to 100% cash. The indexes will, because they tend to go in bigger blocks, but the individual stocks usually would go to about 60% in cash is extreme. Right now we're 40-ish. If things get a little worse, we might get to that 60, maybe 65%, but you're not going to go much lower than that because a good screening process that, there were stocks that were up today, just like any down day, there were stocks up. When you have a full-out banking crisis, collapse of the financial system, a little bit different. We're not at that point in time where those, at least at the moment, those elements are not happening. We might see risk come off. We might see things get pretty I guess defensive, but there's still going to be stuff out there working, and you're going to be willing to do that. So stay in. You want to be in the market at some level because you can actually build a perfect portfolio that goes up in a down market. That's actually possible.
Yeah.
So where do we want to go from here, Mitch? On understanding that, you want to go to the maintenance, and it's showing uniquely that you built this, so I can't go into the wizard.
Oh, there you go.
So
well, we can go ahead and create a fresh one, or do you have a
no?
portfolio?
Why don't you just I'll log out and you log in.
Oh, geez, now I got to actually know my username.
Oh no, forget that. See, that's Mitch. Has no memory whatsoever. He doesn't remember anything. He uses all of his devices. I was telling him when we didn't have those devices, for us old school guys, we had to remember everything. So we didn't have an iPhone with us. So let's see. Do we need to do that to show this?
Yeah, we'll have to log in as me. So let's see if I can.
Do you have it? Can you drive?
Let me see if it'll let me drive.
You know what? It won't because I didn't turn that on.
There you go.
That's why that's not working. Let me do that real quick. All right.
Bear with us, folks.
I'm just trying to find the icon for...
It was just there. Here, go to the G at the bottom right.
Yeah,
right
I see it there now. I had to click on that to get it go. Quiet. Allow remote control. I did not do that. So now you shall be able to
There
do
we
that.
go. All right, bear with me, folks. I got to hunt and peck this thing in. All right. Bear with me 1 second.
Now we're going to New York Stock Exchange, so the whole world doesn't have your password.
All right.
Anyway, well, Mitchell let me know when he's up and doing it. Maybe I should have. Matter of fact, I'll go to just me so you can't see his head bouncing around. That's kind of awkward. So anyway, what we're going to go through on the maintenance here is really talking about how to update and walk forward these screens. And this is probably the one place where we see an awful lot of mistakes made in, and it's it's kind of depressing actually, because I hate to see you guys have some really good stuff going and then, like we said earlier, chopping them off at the right at the knees when good things are happening. So it looks like Mitchell has managed to get logged in. We'll come back side by side again. Here's back.
All right.
So I guess, do you want to show the start and stops, or where you want to go?
Yeah, that's what I'm going to do on this. So give me 1 second. Why don't you go ahead and select it, Bob? It's not letting me drive again. So go ahead and select Warriors Growth from the list there.
Yep. Growth ER?
No, just Warriors Growth.
Oh, there it is. Yep, see
there
it.
you go.
Okay.
And then, as you can see in the wizard, there's actually 144, 146 symbols.
Yep.
So there's been quite a few names, a little bit of turnover that's taken place over the life of this portfolio, which goes back to the beginning of the year of 2008. And that's to be expected when you see a portfolio. You're going to get a fairly lengthy list of stocks over time as you screen and switch out names as they go on. So just go ahead and grab any one of those stocks that are red. And if you haven't done this before, you should actually be doing this. Whenever you maintain a strategy, you should be using these starts and stops in place. And what this does, this gives you an accurate representation over time of the stocks that have come and gone on this list. You don't want to actually delete the stock from a list if it no longer is getting traded. What you want to do is put a stop in place, so that way for the period of time that it was active, we can see the activity that's taken place. And then when it stops getting utilized because the screen has turned it off, what we want to do is put a stop in place, and maybe we'll pick it up later on like we did in this case.
So in the case of walking forward now, once you start this portfolio live, then this list that you're going to have, your trade log list, should look just like the one on your custodian. There should be very slight differences. If you're doing things off the open, you should have everything pretty much in place there to be able to do that.
Yeah, so in this case, this is a great example. You see that on January 2nd, 2008, there was initially a stop in place. So this is one of these stocks that wasn't on the portfolio at the creation, the hypothetical creation of it on January 2nd. It wasn't until 2010 that we actually brought this stock around in the portfolio. So what we would do, and what you should be doing on any stock portfolio or any portfolio where you're taking and removing securities over time, is you put initial stop in place if it wasn't present at the creation of the portfolio, and then you put a start in place at the point that it actually did come live within the strategy. So as you can see here, it was part of the 2010 screen. So it was active from 2010 to 2011. January 3rd, 2011, it fell out of favor on the stock screen, so we put a stop in place. The following year, in 2012, it reappeared on the stock screen, so we went ahead and put a start in place. And then I believe this particular stock was delisted or went private on August 8th. So that's why there's a stop in place. And then there's an extra stop in place in this case on January 2nd, 2013, because obviously it wasn't part of that screen. That second stop isn't necessary for 2013, but I have a couple tricks that I do on my end just to cut corners, make it go a little bit faster. So that's why you're seeing this. But if this were something that you would be running, this is exactly what it should look like, minus that final one. If you want to click clear, Bob, on the 2008 one, we can actually remove that last one and have an accurate representation.
Which one's that?
The January 2nd, 2013. Click the clear button. There you go, and just click apply at the bottom.
Thank you for telling me that.
Just making sure. It's been a while.
He always treats me like I don't know what I'm doing. I actually built this thing.
So this is a great example of what you should be seeing within the activity of an active stock portfolio. If an advisor contacts us and they have questions about a stock portfolio, one of the first things that we do is we pull up their portfolio, we look at the starts and stops on it, and right away we'll know if this is actually something that they've been properly maintaining. Because if we don't see any starts and stops over time, and let's say they've been running the strategy for 3 years, we're almost assured right away that this is something that they haven't been properly maintaining. What we should be able to do is we should be able to see all the activity of the stocks coming and going because of the different screens, and then we'll be able to see what positions have come and gone.
Well, I'm messing up with Mitch. You can see what I'm doing, but
I'm cringing at what you're doing. So.
Yeah, what I'm doing is I want to move on because I want to get to the point. We're only about 15 minutes late where we talk about the actual maintenance. So that's the mechanics of that. We have some videos here. One of the things I just did, I ran the allocation factor. Okay, and this is what you do not want to do. You don't want to apply or hit next here. If you do, that's a really bad thing, because what will happen, if you have 140 stocks in there, it's going to change the allocation factor, which is one of the big mistakes we see. So I wish there was a way to just like gray out that step if it was coined as an active portfolio. We've looked at future ideas to be able to do that, so it would eliminate some of that issue. So that's always a problem there, I guess, when you're going to that. So if you run this, see it's currently at 065, it would go to 0098, which then would tell you that you would, with your current active list, you would have about probably 10% long, if that. It would just mess up everything. It would screw up the entire back test. Everything's toast. Good news is, Mitch, I'm probably saying in his line, we save from every Tuesday all these settings. So if you do that, reach out and we can put Humpty Dumpty back together most of the time. Yeah.
A great preventative measure is at the point that you construct a portfolio, print off this page right here, because then it shows you the inception date, shows you the beginning equity, the minimum transaction, all those key settings, especially that allocation factor. And if you do that, if you keep that in your books of record right along with the stock screens, you're going to be sitting pretty. But as Bob did say, we do create copies of this so we can see what the settings were historically on it to proactively try to notify you guys if we see any sort of movement. Maybe if you're watching this right now, you've already gotten an email from me, or from the system, I guess I should more accurately say, which states that we've seen that there's been either a change to your inception date or your allocation factor. If you, in the maintenance mode of it, change either of those two settings, you're going to be inviting problems upon yourself, because those two settings were not meant to be changed once a portfolio is created and run. It's going to start skewing the amount that you deploy capital, as well as some trades may magically appear or disappear if you have adjusted with those settings. So what we need to do is keep a copy of that, and you need to be religious, be devout at keeping a copy of that every time that you do an update.
I never thought I'd meet someone who could talk more than me. We got to get to maintenance. We don't. That's too long of an explanation for 10 minutes we have left. So let's. What I want to show you is that this thing is always. You can see here the Warriors growth is invalidated, right? And the reason why that is because we made setting changes. So right before you call us and say it's invalid, you just go in. I'm going back to the wizard here fairly quickly, hopefully. It's
No, you're broken.
no, it's okay. It's just I'm pushing a lot of bandwidth out of here. I'm pushing video, pushing everything, trying to make it work. Although maybe I did break it. We'll try it again. Anyway, you just want to go in and hit the run side. So I want to get to. Come on.
Go ahead and scroll all the way up, Bob. There it is.
I don't want to do next. That's what was happening, right?
Yeah, you're zoomed in too much.
Yeah. Okay. Thank you for that. So anyway, what happens when you do that? I could have sat there for 20 minutes, still trying to figure it out. So now it's in the allocation queue. I just want to show you here, and the allocation queue will actually. What happens in VPM every minute? It looks for anybody and everybody that's queued up portfolios, and it will run them and update them. So all you have to do is do that, and I'm going to need that queued up so I can show you what's next here. So I'm reloading this thing, and of course it kicked me all the way out. That was smart. So that, oh, there it is.
You should still be logged in, yeah.
Yeah, so anyway, we're going to go here, just refresh this screen. Hopefully we'll find it is run now, so that is run. So let's talk in about 10 minutes here. Let's talk about, let's say we have just got our new screen. We've updated our screen, and we're actually, this is probably going to have to flow over to next week as I look at it, because there's some really detail here on what it's going, what you need to do. And so I was hoping, I was drastically trying not to break my promise from Tuesday, and I just broke it because we got through the basic steps, but the real critical steps on this is actually looking at the current holdings and starting to evaluating it. So I think what we'll do on Tuesday's meeting, we will start there. We'll continue to walk this forward. Is what we're going to do is talk about the exact process where we'll have some stocks that we want to implement. We'll make some choices. We'll go through the list, because what you want to do is look at what's currently long, look at an evaluation of each one of those. So that's going to take a lot more than time that we have. That's what I wanted to do 30 minutes ago. So we got going too much. A lot of detail. Once you get through this and you understand it, though, folks, it's done. I mean, it's pretty second nature after you get to that point. It's just getting to that point to get there. See if I can make this a little smaller so everything fits back on the screen there. But so we will do that on the next meeting. Let's come back. You've been talking to the talking screen, so we'll come back and we'll go back to our favorite place, the New York Stock Exchange. And the final few minutes that we have here, we got about 8 minutes. One of the setups that I really need you folks to understand is to make sure that you're not doing too much within this process. So these are some of the settings that we need to go through. And the unfortunate thing when you started explaining this, there's just a lot that maybe you don't need to understand everything, but you need to understand that it needs to be done. Goes to whoever that advisor said, just tell me what time it is, don't tell me how the watch works. Well, if you're going to do this stuff, you need to understand how the watch works to a point, then you need to know what steps need to be done. And, so the next meeting we'll start off by actually going back into the wizard, taking a set of stocks that we'll go look at the screen, say, okay, here's the stocks that we chose off the screen to update. We'll look at the current constituent list, and we'll update this strategy and walk it forward. So I guess next meeting will be called Walking It Forward, because this was really about screening, looking at how to get things in there, and how we did the annual screens and the turn on, turn off. So there's possibly even other elements just working with the screen that could be discussed. And so I remember when we started this whole format, I said, you know what? We could talk for 5 hours every day. Of course, you guys couldn't handle it, but we could do that because there's a lot of information here that we could do. We wish there was a way to automate some service, some way to actually get this stuff done for you. But we're working on on a couple ideas along that line indirectly. And I think that will be where we're going to go from the standpoint of being able to help you authenticate these processes and walk them forward. So Mitch, you got anything?
Any closing thoughts?
Yeah.
No, I think I burned through my words per minute for today.
I don't think so. I don't believe that. But we're very passionate about this product that we built, and when we see it used the proper way, it is just magic. And we see this happen all the time. We've seen practices changed. We've actually made advisors smarter than they were. And they get so smart that they leave us and try to do it on their own, and then some of them come back. Some's ego are too big. But there's a lot going on here, and if you use a structured process like what we're offering, it's a lot easier to monitor and walk forward if you have some of this process being automated. It would be very difficult to do what VPM does, especially on the individual stock level, to maintain and rotate stocks and all the buys and sells and looking at everything it would take to do on a manual basis. 24 stocks would be a very, very big task. And we can run it, and we do run it on S&P 500, Yeah. So I think on an admin level, we can build a portfolio as large as 1,000 stocks. Trying to follow buys and sells and allocations and do all that on 1,000, the S&P 500 is pretty intense. There's usually 20, 30 orders every week, pretty much. Not always, but there is that. So okay, I think we're pretty much done. Unless you got some closing comments, we'd actually end up the show a little early today. There just was not enough time to go into the detail of walking forward. So Tuesday will be the focus, and it's interesting because I used to do these 2-day seminars, and I would spend all Saturday morning. I think on Friday afternoon we were building. We'd start Saturday morning at evaluating and validating the strategy, and then implementing the strategy, and then maintaining it. That was a whole day. So to that merit, I mean, it does. There's a lot of words that you need to hear. So I guess if it takes us 4 or 5 of these shows to get through this, and then go, oh, we forgot to say something about that, then we'll try to key in on shows where we just focus on a couple things. So I think for those of you that are serious about being a good VPM strategist, having these in-house products that we help you build, it's going to be more than worthwhile to hang out with on the Mitch and Bob show here. So with that, we got about 4 minutes. Mitch, if you got nothing, we're going to go ahead and sign out, and we appreciate, once again, everybody. We'll see you in the morning. Should be a big show. Let me just see if I think I have the S&P up here real quick. Yeah, we're down 1778, down 169 on the Dow Jones yet, as we said here. So it's still under pressure. Doesn't look like there's much of a bounce in the last 3 minutes. Probably not going to bounce much. So anyway, folks, we'll see you at Market Thunder in the morning. And there's going to be a lot to talk about with this breakdown in stocks that we've seen today. So have a great afternoon. See you in the morning.